Recording in progress.
Hello, this is a sound check. I'm testing the English channel. 1, 2, 3, 4, 5, 6. Testing the English channel. We are going to start with Flar's webinar on outlooks, risks, and capital flows in Latin America. Ok, paso al español, chicos.
Hay otra clase que termina 9, lo elimina.
¿Por qué te escucho, Raúl, malamente? ¿Por qué te escucho, Raúl, malamente?
Elimina solamente.
progress. In progress. In progress. In progress.
Hola, buenos días, ¿me escuchan?
Hola, profe, buenos días, sí, se me escuchó.
Hola, buenos días. ¿Me escuchan?
Buenos días a todos, ¿cómo están? Equipo,
Hola, hola,
yo
Carlos.
soy Felipe, ¿cómo van?
Bien, bien,
Amigues.
¿tú qué tal?
Bien, muy bien, muy bien. Hoy me
Carlos,
ves
¿cómo
sin
estás?
corbata. No sé si está bien la cosa, acá la tengo al lado.
Toca mirar cómo están los otros panelistas. Yo quería decirles algo a Yusei, y es que estoy en el Zoom público y lo que estamos hablando acá se está escuchando en el Zoom público para que cerremos el
Muy bien.
micrófono.
Ok, voy a
Bueno,
ver.
muchas gracias. Me voy a enviar también conexiones a YouTube que tengo acá, entonces espero el silencio y
Good morning, dear attendees from all over the world. I would like to welcome you all to this webinar on outlook, risks, and determinants of capital flows in Latin America. We are delighted to have keynote panelists today who are experts on microfinance and capital flows in the region. So this is a perfect timing to discuss this subject matter against a global context characterized by increasingly international interest rates, geopolitical tensions, and economic fragmentation that is having a toll on capital flows at an international level. The purpose of this webinar is to analyze how these global factors and regional factors, as well as local factors, are having an effect on capital flows to Latin America, as well as all the related outlooks, risks, and opportunities. In our region, external finance is critical to macroeconomic stability and for growth prospects. For the purpose of this webinar, we have some keynote speakers. We are joined by Maria Paola Figueroa, Head of Frontier Latin Research at the Institute of International Finance, Martín Castellano, Head of Latin American Research at IIF, Jonathan Fortun, Senior Economist at IIF, and Martín Tobal, Director of Macrofinancial Risk Analysis at the Central Bank of Mexico. Each panelist will start out with a presentation, and then we're going to open the floor for discussion. We have prepared a list of questions from the participants that have kindly sent in their questions. So we're going to start out with the presentations that will be delivered by Jonathan, Martín Castellano, and Maria Paola, who have plenty of experience under the belt exploring Latin America from different positions in the private sector, the academia, and central banks. So Jonathan, Martín, and Maria Paola, we give you the floor in order to hear your insights about capital flows to Latin America, and thank you very much for accepting this invitation. I'm Jonathan Fortun. I'm Senior Economist at the Institute of International Finance. I'm responsible for global macroeconomics and capital flows at IIF. Today, the purpose of my presentation is to walk you through the global dynamics underlying capital flows in the short term. I would like to share with you an outlook about the drivers pushing such dynamics, as well as share with you my insight as to what we could expect going forward. In turn, Martín and Paola will focus more on Latin America. So I hope I will be successful in sharing with you this global overview. Here's the first slide. So let's talk about capital flows over the past 6 months, and particularly over the past 2 months, have been quite positive. We are talking about capital flows going to EMs. This has been due to several reasons that we will be exploring shortly. Let me highlight 2 key aspects. First of all, debt towards EMs. Such debt has been quite successful in terms of portfolio capital flows. Up until 2020, China used to receive most capital flows. Thereafter, however, this dynamics shifted. China no longer receives so many capital flows as it used to, and other emerging countries, however, are now increasing their share of capital flows. Let me highlight two fundamental aspects. Capital flows, in terms of portfolios, have been characterized by being stated in local currency rather than foreign exchange, which is quite significant because it points to a significant difference compared to the past when FX capital flows were commonplace among international investors. On the other hand, and despite the great success of portfolio flows, globally speaking, we still see some variance or some noise, so to speak, as for equity portfolios or international investments. This is due to AI having an impact on international markets and NASDAQ listed companies' performance. So capital flows to emerging countries have been affected by all this. We should highlight the success reported by many local stock exchanges, particularly in Chile and Colombia, or even Brazil and Mexico. Equities performed quite well. However, we didn't see high participation coming from foreign investors, at least in these stock exchanges, in those countries where in the past, investors used to have an active participation, such as in Chile. We haven't seen foreign investors taking real advantage of that, as it has been the case in Korea. Just 1 week ago, investors showed great interest in the equity market in Korea, but not in Latin America in this case. And finally, I would like to review developments in January concerning foreign capital flows, debt flows, as well as equity performance in China. All that resulted in 100,000 billion US dollars in capital flows. And this can also be accounted for by some debt issuance that took place in several emerging countries that issued debt. Let us recall what happened with Ecuador. This has been quite interesting, in fact. Now, let's turn to the following slide. Many emerging countries have been able to take advantage of the reduction in the cost of issuing debt. Some frontier markets, such as Egypt, Bolivia, or Ecuador, or even Venezuela, and this is due to the current geopolitical situation, they have all seen a significant contraction in the so-called EMBI spreads. We can also see what happened in corporates outside of Latin America, where there has also been a significant role being played by debt issuance. But this does not happen only in 2026, as you can see on the right-hand side. There has been a process of decoupling as for U.S. yields concerning 10-year Treasury bonds and the so-called EMBI. This has been the case since mid-2025, as you can see on the right-hand side. And this is extremely important. Theory points to the fact that emerging countries will usually be above the risk premium of the US 10-year Treasury bond yields. So decoupling has been quite significant. This shows that to some extent, debt dynamics across capital flows towards emerging countries is now changing. And this therefore means that foreign investors' risk appetite concerning emerging countries is now on an uptick. This also goes hand in hand with the dynamics reported by the US dollar, as we can see here. As you may very well know, the US dollar has been performing in quite a peculiar manner over the past 1 year and a half, with a slowdown in these currencies' performance compared to other currencies. There is not a single US market price. Actually, there are at least two different market prices for this currency. The first one, which is compared to that applied to advanced economies, and then another price vis-a-vis emerging countries. This slide shows US performance in nominal terms, not actual terms, for each of these currencies, of each of these currency baskets. So these currency baskets have been weighted according to the trade matrix provided by the United States. As you can see on the slide, the US dynamics, mainly in EMs, has been even better if we compare these dynamics against that reported by developed countries. This therefore shows how debt denominated in home currency has been quite significant for EMs. There has also therefore been a change in the strategy of foreign investors as for their interest in EMs. But there are other drivers apart from this. The policy-making process, or debt issuance administration, or monetary policies within emerging countries have been much more important, or have had a much greater weight compared to what was the case prior to the COVID-19 pandemic. And that's why we see this behavior on the part of emerging markets. So in the aftermath of a more inexpensive US dollar, we see that the carry trade has also played a significant role. That is to say, obtaining funding in foreign currency and then investing that in home currency. As you can see on the left-hand side, these carry trade returns have been quite significant, as it was the case in Argentina, but we could also refer to the yen or the Turkish lira or the yen compared to the Brazilian real. This has opened up a very significant opportunity for international investors to invest in local debt issuance and therefore bolster up these successful dynamics. In other words, we can see that in 2025 and 2026, if you take a look at the red dots in the graph on the right-hand side, US yields had a completely different performance if compared to home currencies in emerging countries. And these fundamentals account for the success of international flows over the past months. This is my last slide, and here I would like to highlight current developments and the white elephant in the room, so to speak. Right now, we are faced by manifold questions due to the latest developments, globally speaking, the impact of oil prices on capital flows. So this graph might seem a little bit negative. There is not a one-to-one relationship between capital flows to oil prices, because when we talk about emerging countries, these countries do not make up a monolith. Some countries are ready to better withstand any shocks than others. However, here we would like to highlight that the most important variable in order to assess what might happen going forward in the upcoming weeks when we talk about capital flows or any potential flows, that the question here is, how long will this uncertainty last due to the current situation in the Middle East? And here we're not talking only about oil prices, we're also talking about liquidity, which is governed by interest rates at an international level, as well as by financial conditions that will govern the market. As a general rule, we believe that the lower the liquidity, the higher the capital flows probability towards emerging countries. But finally, I would like to mention, as you can see right at the bottom of the screen, capital flows towards Asia, China, and Taiwan, to a lower extent to Korea, South Africa, and Hungary, are the ones that over the past 4 days reported about 3 billion euros, $3 billion US dollars, sorry, going overseas. In the case of Brazil, Philippines, Thailand, Pakistan, well, these countries have not yet observed any outgoing capital flows due to Middle East current developments. However, we have to wait and see, and based on our data, we will have to, see whether this will eventually play out in one direction or the other in the future. Now, I would like to stop here so that Martina and Maria can continue with their presentations. Thank you very much, Jonathan. Thank you very much, and good morning, everybody. As Jonathan has just said, the war in the Middle East has brought about sort of a stop, which is affecting the price of assets, rather than affecting capital flows too much. However, up until now, the scenario was quite positive for Latin America, with capital flows accounting for about 5% of GDP, well or far above the amount reported in the prior year. Early this year, we thought that in 2025, the world was going to come to an end. However, capital flow performance in the region went far beyond expectations. This graph shows the quantum leap reported in 2025, which was quite widespread, not only broken down by type of investment, but also by country. As Jonathan mentioned, for example, equity or stock portfolios where performance was negative, or equity performance, as in the case of Mexico, which also performed below historical performance. As Jonathan mentioned before, the dollar is weak. Carry trade finds interesting interest rates in terms of the spread with the United States. And I would like to add yet another factor, something that investors perceive. They believe that the region now has this capacity to deal with political shocks and navigate through this scenario. And this has also had an impact on capital flows. Several times at this same forum, Paola and I have discussed the current position that Latin America has in the current uncertain international scenario. Venezuela is an example, is an exception, but we can say that somehow these conflicts affect Latin America, but to a lower extent. However, trade activity comes down, then we could also refer to commodity exports or the experience in negotiating tariffs or reaching free trade agreements, all of which make it possible to reach an agreement after negotiations. What I'm trying to say that this positive scenario reported in 2025 was expected to extend into 2026. Early in 2026, we saw capital flows come into the region, and after the ruling passed by the Supreme Court of the United States and the new round of tariffs being passed, the currencies in the region continued to be revalued upwards. Here you can see, daily and monthly data. Even the stock markets reported significant improvements in Chile, Brazil, and other countries, something that did not happen in the previous year. In the aftermath of the COVID-19, the world economy became more sensitive to the disruption of the supply chain or energy or logistics bottlenecks, with oil prices going up quickly, with the dollar price also going up, and the tightening of financial conditions for emerging countries, reducing the leeway of central banks to take action, as we can see here when it comes to asset prices. So there is uncertainty as to the scope of these shocks. We thought that it was going to be limited to what happened to Venezuela only, but right now we do not have full visibility of what one could expect. If we believe that these shocks will be temporary or limited, we believe that the region might grow at a rate of 2%. That was our forecast prior to the start of the war, with, of course, some moderation in capital flows as shown on the slide. Nonetheless, right now, we wonder whether this might turn into a global crisis with some inflationary effects and also with a toll on economic activity. Albeit the region is now better prepared to face these geopolitical changes, I believe that there will be a more selective approach by countries. Each country faces these shocks differently. There are some countries which are oil exporters or energy exporters that will be affected in a different manner. So the emerging risk as such is no longer as homogeneous. Against this background, we believe that the positioning of foreign investors in the region when it comes to portfolios is quite low, as it has been the case historically speaking. This graph shows that portfolio flows and portfolio investments in the region remain low. Right now, in times of high uncertainty, this could translate into an asset avoiding significant disruptions. We believe that this debt market trend will remain unchanged regardless of the context. A new opportunity windows will be sought. One fundamental here has to do with the level of reserves that countries now hold. Now, talking about reserve flows, we believe that this year they are expected to grow. on a widespread basis across countries, despite the fact that we see some resident outflows in the region. This is a chronic factor, and in election times, or when there is hectic elections activity, this trend tends to be amplified. Let us now talk in more detail about what we observe in each country. Usually we do not deep dive into this at these fora, so today we would like to do so. In Brazil, there will be elections taking place shortly. We know that Brazil plays a very important role in the region. Then there are external aspects. The outcomes of the enforcement of tariffs have been controlled somehow. The shocks have been mitigated with a commercial policy that has been quite reconciling and that has made it possible to obtain some exceptions. As for the capital flows reported by Brazil, they were quite positive early this year. They have a monthly balance of payments. Therefore, FDI increased by 30 to 40% back in January compared to the figures last year, the same as portfolio investments, which performed quite well in January and February in Brazil. The debt strategy is now shifting slightly. Brazil has flexibility to increase its exposure to FX debt because the percentage of debt of the country is quite low, and therefore I believe that Brazil might tap into this strategy in the current scenario. Geopolitical relationships, however, remain under a lot of stress. Brazil might walk out as a big player, some people claim, but we have to take that with a pinch of salt. Brazil became an oil exporter back in 2017. We believe that an increase of $10 per oil barrel would lead to $4 billion of additional inflows for their current account. Given the fact that current account deficit in Brazil was relatively high last year, reaching 3% over GDP, this could also be a way to curb the deficit. The key here is to determine how much or to which extent the Central Bank of Brazil will be able to cut rates in this context. Maybe they might front load this cutting interest rates, but we don't know whether that is going to be possible or not. I believe that Martin will talk about Mexico specifically. Let me just mention that from a geopolitical standpoint, cooperation and willingness to reach agreements with the United States and the change of policies of Mexico somehow position the country quite well to negotiate new free trade agreements, despite some complications. All in all, however, they have performed quite well. Talking about governance, the graph right in the middle shows the investor sentiment. This is a report prepared by the Central Bank of Mexico in times of external shocks, such as the COVID pandemic or the war in Ukraine. And right now, everything that has to do with governance, as shown in gray on the graph, all these elements continue to be important because they affect growth, investments, and capital flows. Let me now turn to Argentina. In Argentina, we see that the country is far less vulnerable compared to its situation 2 years ago. Very often we lose sight of the starting point in Argentina, where inflation was through the roof and where the country was about to default on its debt payments. Now, if we take a look at inflation rates, the maturity schedule, etc., and the size of the domestic market, we see that Argentina lags behind other Latin American countries. However, the geopolitical situation has somehow contributed to offset some vulnerabilities. The fact that the country now has a much sounder financial position has made it possible for the country to access foreign financing. Oil prices also have a positive effect on Argentina's current account. This changed. Back in 2024, Argentina became a net oil exporter. So in the current context, Argentina may expect not to have additional outflows of US dollars. We expect a pro-market approach going forward. The question is how these changes will be implemented and the progress one could expect after negotiations that are ongoing in Congress right now. On the other hand, as Jonathan said, non-residents have not participated in the domestic market or in the home market. Pension funds have increased their share quite significantly after the withdrawal of more than 40 billion US dollars. But not only that, savings have been channeled through voluntary savings mechanisms, which is quite interesting because this points to the behavior of residents in the home market. Now, let me hand over to Paola, who will cover other countries in the region. Thank you. Thank you very much, Martin, and thank you, Carlos, for having me, for allowing me to participate at this webinar, which is so timely given the current global context, which has a significant weight on capital flows. I'm going to talk about the macro context and the drivers concerning capital flows in Colombia and Peru. And I would like to make some closing remarks concerning Venezuela, because Venezuela is also an important player when it comes with FDI in the region, with some significant spillover effects for other Latin American countries, not only with those countries that are neighboring countries or share the same borders with Venezuela, but also other countries in the region that might be affected by current developments in Venezuela. So let me start out with Colombia. Colombia has kept its access to external financing with a clear structure of capital flows in addition to portfolio investments. As a result, Colombia's exposure to global risks has gone up, as well as the risks of what we call tax perception. FDI moderated quite significantly year on year, and this shows not only a much more selective global market with a focus on EMs, but also some domestic factors that have already been discussed, such as regulatory and tax uncertainty in the country. By contrast, as you can see on the left-hand side, the red bar shows portfolio flows, which have become increasingly more important over the past year, driven by the purchase of bonds denominated in local currency. They have been bought by the government, external investors as well. And also we have debt issuance. All this has a direct relationship with tax matters and the needs of financing of the Colombian market. Interest rate spreads have been quite significant compared to other emerging countries or other countries, translating into carry trade, increasing the demand for peso-denominated assets, causing the Colombian currency price to go down. Then we have real inflows and government FX operations, which remains vulnerable and which has had a significant effect on the FX market. From an external perspective, FX supply has been affected by structural matters, with remittances hitting a record high, consolidating themselves as a significant source of revenue for the economy in FX. There has also been an active tourism sector, and then coffee exports, which also performed well and made a contribution. Therefore, current account deficits has been about 2.4% over GDP, so it has been quite contained, reporting a significant improvement if we consider current account performance in the previous period. Nonetheless, there has been an increase in the trade deficit, which is closely tied to the strength that is now being shown by domestic demand in the country. The evolution of flows has also been conditioned by the macro and domestic context. But before I refer to this topic, I would like to clarify that all these flows and the fact that Colombia maintained access to external financing, all that led to an impairment in the perception of economic risk, by contrast with what Jonathan mentioned before when he spoke about what is happening in other countries in the region, or in Venezuela, for example. By contrast, we observe that in Colombia there has been sort of a deterioration or impairment concerning risk indicators, so the perception of risk concerning the country. Let me now turn to the following slide. This is the current macroeconomic context that has been supporting investment flows. On the one hand, activity continues to be bolstered by household consumption as well as domestic demand. All this has been propelled by an expansionary tax policy, an active tourism sector. But then we see on the downside an underperformance of investments. Last year, there was a slowdown in FDI, and that somehow reinforces the fact that GDP has fallen significantly if we take into account the potential growth that was expected. From an inflation perspective, there was a slower disinflationary process compared to other regions, other countries in the regions. And then we also see persistent inflation, wage pressures, as well as in domestic demand that remains quite resilient. The monetary policy was quite restrictive in the country, and it has performed in a quite agile manner. Responding in a quite agile manner in the face of current developments, the Colombian administration decided to increase the minimum wage by 20%, which has had significant repercussions, and that led to some changes in inflationary expectations going forward. Therefore, going forward, we might expect a significant increase in inflation. We thought that it was going to be 4% for 2026, all in all, or perhaps below that percentage. And right now we are pricing in inflation rates that might stand at 6%. As a result, we might expect a restrictive monetary policies, high interest rates that might persist throughout 2026 and even in 2027. This points to a serious approach and the fact that the Central Bank of Colombia is keen on curbing inflation. However, we believe that there will be some carry flows which will be more significant compared to other countries such as Peru or Chile, which have cut their interest rates quite markedly. So if fiscal deficits remain high, and this is quite important for the purposes of capital flows, despite the fact that we might expect a slow improvement of 6% of GDP, this remains quite high. We're talking about fiscal deficit. This is due to a reduction in the cost, in borrowing costs, and this has led to new actions that had to do with bond swaps by the government or buyback programs. All this has made it possible to improve some tax metrics in the short term. Nonetheless, all these transactions do not change the structural pressure on tax accounts, and somehow we still see some shortfalls despite these issuances by the government. That is because the government's cash position has been significantly affected, showing deterioration and showing a difficult tax situation going forward. And finally, we should refer to the political scenario and the implications that this could have on capital flows and the Colombian currency. This is an increasingly more important determinant right now for capital flows to Colombia, also for the foreign exchange rate. There will be parliamentary elections coming soon on March the 8th, which is going to be important because it will give us sort of a real picture of what we could expect going forward. We don't know which the outcome of that election could be. However, we might expect parliamentary fragmentation, which could eventually affect the elected government's capacity to obtain support to pass laws or to limit any potential fiscal adjustment. And maybe I would like to refer briefly to Peru now. Well, in the case of Peru, we have observed significant exchange levels. This has been a driving force for growth and private investment. There has been quite a significant surge, also external strength, as you can see on the graph on the right-hand side. There was a trade surplus in Peru, quite higher compared to that reported in other countries in the region. Inflation remains within the target, but there has been a recent spike related to some climate developments. However, underlying inflation pressures remain quite subdued. In this respect, the Central Bank of Peru cut interest rates quite significantly, but over the past weeks, we have observed a more cautious approach, maybe due to political uncertainty and also due to the impeachment of the ruling president, which is now stirring up political uncertainty in the country. Let us now move on to the next slide. Elections in Peru will show how fragmented the country is. However, some institutional changes have been implemented, which have been quite important. For example, institutional improvements at a Senate level. The Senate will start functioning in a different manner after these elections. There have been some institutional changes, therefore, that might lead to improved governance and the country's institutional stability. And all these should translate into increased capital inflows. There has been external financing coming from private sources, and this has also grown quite considerably, showing corporate confidence in the country in line with a significant rise in copper prices as well as other metals. So this confidence translated into increased financing in engineering and mining projects coming from investors. There has also been a new approach to equities by non-residents, which is also a change in trend compared to previous years. FDI remains strong, but a big portion of foreign direct investment had to do with the reinvestment of proceeds obtained by those sectoral players, and that might change going forward. Let me stop here, and afterwards I may give you more color as to the situation in Venezuela. Thank you very much, Martin, Jonathan, and Paola, for sharing your insights with us. During your presentations, you have shared with us quite a complete picture about the current situation of capital flows. From a global perspective, the highlights are current international conditions, particularly financial conditions, mainly risk appetite for emerging countries. From a regional standpoint, you have underscored the challenges and opportunities that Latin America now faces in the current context. It is quite clear that emerging countries are not monolithic, and investment decisions vary country by country due to different reasons. And such reasons are defined by the interaction of global factors, for example, financial conditions, as well as the geopolitical tensions we now see, as well as macroeconomic effects and the strategic positioning of each country. These might continue to increase differences in the future. We can also see how the current geopolitical shocks could affect oil prices, but could also affect global liquidity. But we are going to discuss this later on, as Paola has just pointed out. Now, let me give the floor to Martin Tobal. Martin, thank you very much for accepting to join us today. Thank you very much. And I would appreciate if you could keep your answer short so that we can have a fruitful discussion for the entire audience. Thank you very much, Carlos, for having me. I would also like to thank the whole team of Flar. I'm Martin Tobal. I work at the Central Bank of Mexico. I would like to highlight that what I'm going to be presenting today has to do with my own vision and has nothing to do with the personal vision of the Central Bank of Mexico. So if we compare the current situation against prior scenarios, we must understand what those differences represent when it comes to public policies going forward, as shown on this slide. The title of this presentation is Why This Time is Different. As you may notice, this is quite an ambitious wording, despite the fact that I did my best in preparing this presentation. I'm sure that I'm not going to be as successful as the original authors of this paper. What do I mean by this time? Back in 2025 and in 2026, that is to say now, uncertainty, commercial uncertainty, and geopolitical tensions have reached the highest levels ever after the pandemic. And this is due to the fact that the tariff narrative and the tariff policy forced by the United States, as well as the emergence of new wars, have increased geopolitical uncertainty. Therefore, for the first time, we see global financial conditions to be tighter compared to the pre-pandemic period. According to this chart, you can see the common component between the interest rates, risk aversion, and stock exchange performances, as shown by the red arrows, that are tightening global financial conditions and lower availability of funds to be lent. But if we take a look at this whole picture of the past 20 years, we see that what happened in 2025 and 2026 is exceptional, not only when we compare this against the post-pandemic period, but also this is a peculiar tightening situation compared to the prior 20 years. Let me clarify this further. The current tightening conditions are similar to the 5 largest tightening conditions that were observed in the prior 5 years. However, the current situation is different compared to the prior tightening financial conditions in 5 particular events which were interconnected and which were related to more severe monetary policy by the Fed caused inflation rates to go up. On the other hand, there was an increase in risk aversion. Of course, stock exchanges plummeted, but in this case, the rates in the United States fell, showing that whenever risk aversion goes up, the Fed cuts interest rates as a response and not as the cause of this very shock. How does this compare with those 5 events of 2 different types? Right now, we haven't observed any U.S. stock exchange falls, but rather an uptick, and the long-term rate in the United States did not go up nor down. It did not show any specific pattern or a fixed pattern, which shows that even though the scope of current tightening conditions can be compared to the prior 5 events, the nature behind is different. This opens a new question, and that is, if stock exchanges have gone up and long-term rates have not gone up nor down, what did really happen? Well, term premiums have gone up, as I said before, due to an uptick in stock exchange performance. That's why risk perception seems to be higher, but it does not seem to be affecting the private sector, but rather the U.S. public sector. And the term risk increase seems to be affecting the U.S. sovereign bonds, but not only U.S. sovereign bonds. If you take a look at other advanced economies under the current tightening conditions, the pattern is the same. So the increase in advanced economies stock exchanges and the lead to an increase of term premiums for the bonds of the corresponding countries. So we're talking about a different nature, even though the scope is more or less the same as the one reported historically. The situation is totally different for emerging economies. So if we consider global tightening financial conditions, normally the currencies of emerging economies are devalued, and this also affects capital flows. This happens in the case of the tightening of financial conditions. This is determined by the Fed. And this also happens in the tightening of financial conditions that have been linked to more global risk aversion. Why does this happen? Because when global financial conditions are tightened and there is less availability of lending, usually investors withdraw from those countries that are considered to be riskier, that is to say, emerging economies, historically speaking. So capital outflows from emerging economies under tightening financial conditions might have been greater in the current context. Why? Well, because there are certain structural characteristics that could have amplified these outcomes. On the one hand, we could think that global savings might have gone down due to geopolitical fragmentation or due to lower production chain productivity and also due to lower long-term growth in China. In addition, this lower growth could also reduce global supply in aggregate terms, but also part of those global savings could have been captured by the advanced economies, because usually these advanced economies have reported more deficit as they have been spending more in military defense and due to the aging of their populations. So how do global financial conditions and capital flows leave emerging economies behind? We could have expected a much worse scenario. However, by contrast with what happened in prior tightening financial condition situations in 2025 and in 2026, we have observed just the opposite. That is to say, capital flows came into emerging economies and their currencies were appreciated. So which is the reason behind these dynamics, and why is it that this time the situation is different compared to the past? And now let me turn to this question. Why is it different this time? Now we need to understand why this time is different now that we know where we're coming from. And perhaps we can find part of this answer by dovetailing these answers to section 1 and section 2. In section 1, we said that apparently there was more mistrust in the public sectors of the advanced economies. In the second part, we said that emerging economies were showing some structural factors. Also, the markets could have lost tolerance to the indebtedness of emerging economies. Therefore, we have estimated, as you can see on the left-hand side, right at the bottom, how the CBO's reviews affect fiscal balance and term risks, taking into account treasury bonds in the country. This leads to an increase in the public deficit, but on the other hand, the tolerance concerning the term premium has increased significantly over the past 2 years. Why? Well, if we take a look at the dynamics in the US, the last 3 recession processes were pro-cyclical with spending going up. And then that is followed by tax consolidation. But tax consolidation after an economic downturn is increasingly lower. So tax or fiscal deficit in the United States seems to follow an upward trend. This has been accentuated after the last downturn period where fiscal consolidation was lower and where it did not have the same scope that one should expect in order to reach a tax balance situation, as it was the case prior to the pandemic. So this shows lower tolerance with advanced economies that could have increased the risk aversion by emerging economies. And as a result, their exchange rates may have been appreciated, and that's why capital flows went into those countries rather than leaving those countries, as it was not the case under other tightening financial conditions situation. In the case of Mexico, the situation was even better because the Mexican peso revalued even more compared to the currencies of other EMEs. But capital flows in this case seem to have been negative in the country, and this is contrary to the revaluation of their currency. So let me show you this graph. On the right-hand side, you can see that this does not necessarily point to lower risk or lower appetite for Mexican bonds. This is due to two reasons. Capital outflows from an accounting perspective may entail that on the one hand, and this is what is normally said, non-residents have less appetite for the country bonds, or else residents have greater appetite for these bonds. Usually economists do not pay attention to this, but when residents show more appetite for domestic bonds, that leads to capital outflows and lower indebtedness by these residents. However, when outflows shows lower demand by residents, the price of assets tend to go down and rates tend to go up. And the opposite happens when there is more appetite by residents, prices go up and rates go down. Therefore, we decided to use this distant performance by rates and assets in order to understand why this was happening in Mexico and why capital outflows were due to lower demand by residents of bonds, or else by a higher demand. And this is our finding. A part of capital outflows in Mexico are due to an increase of demand of bonds by residents. On the other hand, there was a significant drop in long-term and short-term interest rates applied to Mexican debt, showing more risk for these bonds, not lower appetite by residents. If we detract this factor, we can see a similar behavior compared to capital flows in other emerging countries. And there is also an accounting fundamental underlying this. The graphs that I have shown before and which are reported by the Central Bank of Mexico, which is also provided by the IMF. This is something that we use in our own analysis when we have to do presentations to the boards of governors, because all this information can be compared across countries, and this information is normally given to foreign investors. However, these series include information only concerning sovereign debt placed by the government in the local market. Now, if we take into account other types of capital flows, for example, those placed on international markets, or the bonds issued by national countries, or, for example, private equity, and if we add these up to the prior series in Mexico, there were capital inflows rather than capital outflows, more in line with what happened in other emerging economies, and also in line with this risk appetite shown in Mexico, taking also into account the performance of their currency. Therefore, the current situation is different because right now there is more financing available to the countries in the region by contrast to what happened in the past. So we thought that perhaps we could expect that the good times were over for the emerging economies, but that was not the case. Now, it will all depend on whether this increase in appetite for emerging economies will persist or whether it's just temporary. In the second case, if this increased appetite for emerging economies over advanced economies is only temporary, going forward, there could be a significant or sharp adjustment in prices and capital flows. As normally said, if we are in the party, perhaps somebody out there in the room will turn off the music. So what would this imply for the monetary policy? If appetite for emerging economies is just temporary, a tightened monetary policy could increase microfinancial variables, and as a result, future adjustments might be even greater. On the other hand, if this appetite for EMEs is permanent, these economies might tighten their monetary policies even further in order to fight even more aggressively against inflation. And the same applies to the tax arena. If there is more margin, perhaps a counter-cyclical policy may be applied. Otherwise, tax policy will play an even more important role. So in conclusion, even though for the time being the situation seems to be different, and even though the good times are not yet over, as it is normally the case with EMEs, we have to be constantly alert about what might happen. Thank you very much. Thank you very much, Martin, for this interesting view about the current macroeconomic context and for comparing this against other significant episodes such as the global financial crisis. So you have highlighted some key aspects underlying current global financial conditions and capital flow determinants in emerging economies. You have, for example, referred to investors' perception as to the tax situation in advanced economies and an increased appetite for different emerging economies. And this is also related to what our colleagues from the IIF pointed out, particularly for Latin America. So as you said before, these conditions will remain unchanged in the coming months. Well, that's a difficult question. Next, we are going to ask Jonathan if you agree. I would like to share the first question with you. This question is the following. In the current global context, which structural changes have you observed? How do you think international capitals are being allocated to emerging economies? And going forward, is there any global variable that you think that markets are underestimating right now? And this dovetails with the question raised by Martin. That is to say, whether the current conditions will remain unaltered for emerging economies. And do you think that there might be a shift in terms of appetite for our region? In the current context, and based on what Martin mentioned before, and taking into account the risk premium and the current dynamics of advanced economies and the US dollar, all that, as well as market liquidity, all that points to capital flows to emerging countries not being too high. And this is something that is happening. If you would have asked me 5 years ago, in a context of higher inflation rates in the United States, with no interest rate cuts by the Fed, you know that 100 billion US dollars went to sovereign debt, and it all looks pretty crazy. Now, despite all these risks and despite all this uncertainty, and despite the trade channels and so on and so forth, I believe that emerging economies are still pretty strong. Some people say that this is due to the US deleveraging approach. We believe that the reasons actually come from some positive shifts in the emerging economies rather than a crowding out by the United States. Now, what could change going forward? Well, maybe we are misreading US interest rate changes or the US policies. There are many external factors that will start to hit the way in which the Fed and the FOMC will approach rates. AI has had an impact on these dynamics. We have heard that this is an argument whereby productivity might go down in the United States. There have also been some shocks caused by oil performance. On the other hand, the US is no longer in the 70s. The situation has changed. The shock that hit the United States back in 1973 was a different story, but they need to be mindful of activity rates and inflation performance. And then we have trade, immigration, and other domestic policies enforced by the United States, which are very important and which can create a lot of noise when interpreting the U.S. intention going forward, and could also have an impact on the market's liquidity. And this is the most important aspect, much more than what is currently going on in the Middle East. So the question is, how long will this uncertainty in the Strait of Hormuz last? Going back to the first question, we had to remember that a new chairman will be appointed to the Fed. 6 months ago, some people challenged the independence of the Fed, but now that seems to be dispelled. But then there are other specific aspects concerning Latin America, such as the political scenario in the region. But I would say that those are the three key highlights. Okay, thank you very much, Jonathan. Now, from a regional standpoint, Martin, let me turn to you. Do you think that a more active strategy by the United States in the region is contributing to more financing in Latin America? And how do you think that this could be reversed should the conflict in the Middle East become worse? Well, I believe that the U.S. administration is in fact trying to reinforce its leadership in Latin America following a very clear-cut strategy. And this has spillover effects from a commercial and economic perspective, also in terms of technology, immigration, public safety, across spheres. And in general, this interaction by the US takes place through financial channels rather than through formal programs or engagements. Now, there are some similarities with what China used to do in the region some time ago, when using certain economic resources with a strategic view to reinforce its positioning in the region, ensuring access to Latin American markets or ensuring a share of the supply chain or commodities. So this selective approach reinforces the differences across countries, compelling policymakers and authorities in the region to adopt a much more transactional and pragmatic stance that needs to be recalibrated on an ongoing basis. Many analysts believe that this approach is risky. I believe that it could also come with an opportunity for countries so that they can start building institutional credibility, expanding financing options, and galvanizing their economic policy. Right now, the difference between emerging economies and developed economies is more blurred. Perhaps this is going to be more and more necessary in order to capture more investments. From a strategic perspective, I think that this is just as important as macroeconomic fundamentals. In some countries with a stronger position in the region, this may apply less. But in the case of countries with more fragile institutions or institutions that are moving towards macroeconomic stability, I believe that the approach is quite clear. Argentina right now does not have significant reserves. However, the fact that it's being financially endorsed by the United States, or the fact that it was endorsed by the US last year, that somehow helped the country. And as the Argentina builds up international reserves, this could become sort of a supplementary source. Right now, the US administration can play this role in a more direct and bilateral fashion. As for if the conflict persists, well, that could also add to an unfavorable geopolitical context, penting up geopolitical tensions and increasing the risk of making commercial or economic decisions that could eventually be costly in terms of inflation rates for countries in the region. Thank you very much, Martin. Now let me turn to Maria Paola. You said that the region has received a significant amount of capital flows over the past years. So what about these global and local factors? How do they interconnect with each other? And based on the previous answers, do you think that we are in the face of a structural phenomenon in the distribution of factors or in terms of risk appetite? Or do you think that it's a matter of search for carry trade in the current global financial conditions? Well, I believe that all three factors have been equally important, whether the global conditions or the rest. The global conditions or having right now the financial market is more favorable, liquidity conditions are broad, and there is more risk appetite, and all this supports the demand for domestic assets, particularly for cross-border transfer banks that we have observed in frontier countries. At a regional level, Latin American asset classes have been taking center stage over the past few years. And in the face of external shocks, such as the war in Ukraine, we have observed Latin American countries to stand strong to curb their inflation trends. At the time, the region was one of the regions in the world raising inflation, raising interest rates faster. But this gave the region an edge, making the region more attractive as an asset class. We have also observed some improvement in external exposure with a moderate growth, which nonetheless remains stable despite all the shocks. So Latin America was hit by several shocks, but nonetheless it walked out of it much stronger thanks to sound macroeconomic policies that were put in place. And this has been acknowledged by the markets. And then we observe some differences across countries, as Martin pointed out. Some countries with some fundamentals, such as Peru, reported significant flows last year, the same as Central America, that has been able to attract more foreign capital, and this was also tied to macro and fiscal indicators and the carry trade. Costa Rica, for example, has supported this consolidation process, which was quite important for it. We also observe some other differences. Mexico has been benefiting from a new FDI outlooks. Brazil has also been attracting new investment flows, despite from a tax perspective, they still have some risks. And Colombia has also been attracting capital inflows, but more in connection with high interest rates. Against a strong macroeconomic context and the interdependence of the central bank. The carry trade, however, has also benefited Colombia over the past years, and that is therefore the interconnection of all those three factors that have had a positive effect in the region. Okay, let me now turn to Martin. In your opinion, from the macro financial perspective, do you think that Latin America will be capable to address external shocks compared to prior episodes based on the comparative information you have shared with us? And against this landscape, where do you see financial and tax vulnerabilities or gaps? And what about the spillover effects that we might expect from the international markets? I know that it's quite a broad question, so I would appreciate if you can provide us with a quick and short answer. Thank you very much, Carlos. I do my best. Well, in a nutshell, I believe that there are a couple of reasons why right now the region is far more resilient. And rather than calling this fragility sports, I believe that they are opportunity sports. As for the three characteristics making the region more resilient, we should point out the monetary and FX schemes, which are far more flexible today. The foreign exchange rate is depreciating in order to accommodate the shocks we described before, and by contrast with the past, no reserves are being lost by central banks. Eventually, adjustments in the balance of payment are lower. Therefore, that is definitely an advantage than the monetary scheme. From a preventative perspective, and if we take a look at what central banks did in the region, they were one step ahead of the Fed, and they increased interest rates after the pandemic. Therefore, inflation expectations were relatively anchored as a result. Then they eased the cycle prior to the Fed, leaving to more space for their monetary policy, with inflationary expectations remaining relatively anchored. And thirdly, by contrast with prior episodes, financial assistance today are a lot more solid, with high levels of capitalization and liquidity within the banks in the regions. As a result, any external shocks are less likely to result in a banking crisis. As for the opportunity spot I mentioned before, and due to the arguments I presented when talking about fiscal matters, I believe that going forward, there will be a lot more competition in the world to capture funds. And the fiscal scenario will be one where you will have to stand in a differentiated position. And then geopolitical risks that will affect the different countries in a different manner. In principle, that could lead to Latin American countries capturing more flows, with some differentiation within the region. Capital inflows will certainly go to countries with more solid fiscal policies. Argentina, for example, now shows some well-anchored fiscal discipline expectations, and eventually that could lead to Argentina capturing more funds or flows. I don't know whether I have answered shortly or not, but I hope I have been able to answer the question. Thank you very much. Well, since we have many people attending, but since we are running out of time, let me now turn to the second round of questions. But now I would like to ask the speakers to take only a couple of seconds in order to answer. Do we have a deal? Okay, so I will change the order. Let me start with Maria Paola. Maria Paola, you mentioned, you talked about the comparative advantages of Latin America against other emerging economies when you talked about regional and local factors. Going forward, how do you think this could change should the war in the Middle East continue? As Jonathan mentioned, there's plenty of uncertainty around the length of the war, the duration of the war. Now, what happens should oil prices go up? In the region, there are clear-cut winners and losers. There are some countries such as Colombia, which might walk out as a clear winner due to oil exports. And therefore, this could be quite relieving for Colombia after the fiscal pressure that the country experienced up until now. So that could be quite a relief for Colombia's fiscal accounts. On the other hand, these episodes, as Jonathan said, not only have an impact on oil price channels, but also on international liquidity and the US dollar. In that respect, we could expect a bigger global risk aversion that could reduce capital flow portfolios in the emerging economies. There will be differences across countries, and maybe those countries with stronger macro financial factors will attract more capital flows compared to those that do not have the same situation. The actual channels, therefore, could be affected. This goes hand in hand with a very credible monetary policy that has kept inflation low. So we do not expect the monetary policy to be made stronger in order to withstand the shocks. And I think that this is going to defend the country or shield the country against any negative aftermath due to increased oil prices. Okay, Jonathan, could we expect a reversal of capital flows to Latin America? If that is the case, which factors should take place? Well, I believe that over the past 4 years, we have observed that emerging economies have proven to be more resilient. But if we have several shocks, such as higher oil prices and definancing or a timing of or more tightening of financial conditions, all that could trigger off a sudden stop. And there are, of course, black swans, and if the Strait of Taiwan or the situation in the Strait of Taiwan worsened, well, that could also have some spillover effects. I believe that the most important factors have to do with a combination of all the arguments we explained before. I think that the liquidity channel, however, would be the most important trigger as such. Thank you very much. Okay, let me turn to Martin Tobal. Martin, should the global financial scenario deteriorate due to persistent shocks, which segment would be more sensitive to such shocks? And this dovetails with what we have just heard. Exchange rate, reversal of the trend, sale and purchase of foreign exchange, because do you think that we could expect domestic financial conditions or corporate credit having an effect on all this? Well, today Latin American economies are far more open, and this brings about significant advantages, for example, to capture external savings, which is normally quite limited in emerging economies. However, these countries are also more exposed to the developments in the global scenario. This could therefore have an effect in the external context, particularly in the sovereign debt market. In Latin America, domestic credit markets are quite shallow, narrow, are small, and there are some channels which do not exist in other economies that have to do with what goes to the real economy. And this is perhaps not very clear or not as clear in the case of the household credit market or the domestic credit market. In a nutshell, we should expect all these effects to be clearer in the sovereign debt market, which normally tends to be more liquid and with a greater participation by foreign investors. Now, let me close with Martín Castellano. Taking into account the current context and the elections cycle coming in the region, what institutional changes do you think could lead to structural improvements in order to, well, improve risk appetite in the region? And do you think that markets might be underestimating the impact of these geopolitical changes in terms of the regional risk premium? Well, I think that there is always room in order to improve fiscal rules. But I think that if we were able to avoid significant changes, I think that that would be enough in order to already translate all this into a significant improvement. I think that right now, inflation rates are measured in a much more credible manner. Targets are not being changed all the time. Inflation rate definitions have remained unchanged. However, from a fiscal perspective, targets and definitions have been changed very often. So I think that fiscal rules need to be improved. That could certainly have a positive impact, and that's something that would be welcomed by investors because that's something that they keep a close eye on. And somehow I believe that there have been some setbacks in this respect, and credibility has been eroded as a result. As for the impact of the elections and whether this impact is being underestimated, I believe that that is the case. In some cases, we do not know much about the candidates. However, some significant changes could occur in the economic policy of these countries that will be undergoing elections, as it is the case in Brazil. So rather than saying that we are underestimating these changes, well, we should say that we do not expect radical changes to take place. We believe that they're going to be gradual changes, and therefore the role of Congress and the Senate will be key, as it was the case in Argentina, or as it will be the case in Chile, Peru, and Colombia and Brazil next year. Thank you very much, Martin. Thank you all. We have run out of time, so let me close by extending my appreciation to Martin Tobal, Jonathan, Martin Castellano, and Maria Paola Figueroa for your outstanding presentations, for sharing your insights with us, and for taking our questions. Well, given the recent developments, it has been quite difficult to address so many questions. Well, there are many conclusions that we can draw after this webinar. First off, I believe that we need to have solid macro financial fundamentals and robust institutional frameworks in order to reinforce the region's capacity to attract capital inflows and withstand external shocks. In the current volatile landscape, keeping such fundamentals and reinforcing investing conditions will be critical in order to obtain external financing and in order to contribute to sustained growth in the medium term. We would also like to thank all participants joining us today. We hope to continue this discussion in other forthcoming Flar webinars. Thank you very much and have a very nice day and a very nice weekend.